something doesn't add up here. Between October and today, 103 million ounces of deliverable silver vanished from COMEX vaults. That's 38% of the registered inventory gone in 4 months. And during that same window, the price crashed from $121 to $64 in a matter of days. If supply was that tight, how did the price collapse? And if the price collapsed, why is physical silver still disappearing from vaults faster than any time in recorded history? The answer to that paradox reveals something that most investors completely missed while they were watching price charts. Because while traders were panicking over the January crash, two of the world's largest economies were fighting over who controls the actual physical metal. Not the paper contracts, not the futures, the metal itself. And that fight is being waged with something most people have never heard of: receipts. Welcome to Global Money Report. Over the next 20 minutes, we're going to follow those receipts, transaction by transaction, shipment by shipment. And by the end, you'll understand why silver at $82 might not be expensive at all. It might be the market slowly catching up to what the physical flows have been screaming for months. Here's how we operate on this channel. We don't trade on rumors. We don't speculate about shadowy cabals. We follow the receipts. Every claim you're about to hear is backed by publicly available data, customs records, vault reports, official export statistics, mining company filings. Because here's what I've learned after a decade covering markets: transactions don't lie. Prices can be manipulated. Narratives can be spun. But when 500,000 ounces of physical silver leaves a port in Peru and arrives at a refinery in Shanghai, that's a fact. Today, we're going to build a case from those facts, 7 specific pieces of evidence. And I'm going to show you exactly where to verify each one yourself, because the only narrative that matters is the one the data tells. Let's start at the source. Before silver shows up as a number on your trading screen, before COMEX reports it in a vault, before London tracks it as inventory, it exists in one place: the ground. And most of that ground is in Latin America. 5 countries account for roughly half the world's mined silver. Mexico leads with 185.7 million ounces per year. Peru produces 108 million. Bolivia adds 48 million. Chile contributes 43 million. Argentina 25 million. Together, these 5 nations deliver about 410 million ounces annually out of roughly 835 million global mine production. That's just under half. Now here's the critical detail most analysts miss: that silver doesn't teleport from a mine in Zacatecas to a vault in New York. There's a journey, and whoever controls that journey controls the supply. Normally, silver ore gets refined locally or shipped to a major refinery in North America or Europe, where it enters the visible global market. Exchanges see it. Banks can trade it. Price discovery happens. But what if someone intercepted that journey? What if they inserted themselves before the refining step and simply rerouted the flow? That's receipt number 1. Receipt number 1. The upstream acquisition. Between approximately 2020 and early 2025, Chinese industrial buyers executed what might be one of the most aggressive commodity acquisition strategies in modern history. And they did it so quietly that most Western analysts, myself included, didn't catch it until the data had already accumulated. Here's what happened. Instead of buying refined silver on open exchanges like COMEX or London, where everyone competes and prices are transparent, Chinese companies went directly to the mines. They signed what are called offtake agreements. These are long-term contracts where the buyer agrees to purchase silver in its raw or semi-refined form, directly from the mine, before it ever touches a public market. Think about the implications: that silver gets purchased before price discovery. The metal leaves Mexico or Peru, travels to a refinery in China, gets processed inside China's industrial system, and never appears in Western inventory reports. It effectively vanishes from the visible global supply chain. Now, were these deals illegal? No. Were they secret? Not entirely. Many mining companies disclose them in quarterly reports. But did anyone connect the dots and realize the cumulative effect of hundreds of these agreements over 5 years? Apparently not. China was smart. They offered Latin American producers two things: higher prices and long-term certainty. If you're running a mine in Peru and someone guarantees to buy your entire output for the next 5 years at a premium to spot, you take that deal, every time. The individual transactions made perfect business sense, but the collective outcome, devastating, because the silver that would normally flow into Western exchanges and create liquid, transparent markets didn't. It went dark, and the West kept trading paper contracts against a shrinking pool of actual metal. That's receipt number one: upstream acquisition, documented in trade flows, customs data, and mining company disclosures. Receipt number two is where things accelerate. Receipt number two: the flow reversal. Something shifted in the second half of 2025. And I mean physically shifted. Not policy announcements, not speeches. The actual metal flows changed direction. U.S. refineries began reporting unusually large volumes of silver concentrate arriving from Latin America. So much material that refining capacity became overwhelmed. There were literally backlogs, silver waiting to be processed because it was arriving faster than facilities could refine it. Now that's not a price signal, that's a supply signal. It means someone or some coalition of entities decided that Latin American silver was going to flow into the United States, not Asia. Historically, much of this metal would have been refined and either kept in London or forwarded to Asian markets. Instead, it's now staying in the Western Hemisphere. The flow has reversed. Was this coordinated? I can't prove government involvement, but I can show you that the pattern is consistent with what China had been doing for 5 years. Secure the offtake, lock up the supply before it reaches open markets, control the pipeline. Except now the United States appears to be executing the same playbook, faster and with more urgency. And then there was Black Friday 2025. JP Morgan, the largest bullion bank on the planet, made a move that sent shockwaves through the physical market. Reports indicated they effectively withdrew available silver supply from their market-making operations. What followed was chaos. Someone, likely a large institutional player in Asia, who was structurally short, meaning they had obligations to deliver metal they didn't physically possess, was forced into a desperate scramble to cover their position. That wasn't a trade. That was a squeeze. And when the largest bank in America removes silver from circulation and the largest buyers in Asia are forced into panic covering, you're not looking at normal market dynamics. You're looking at control, strategic control. That's receipt number two, the flow reversed. The data is in refining throughput reports, customs records, and the Black Friday event that professional traders still reference as the day the physical market broke. Receipt number three, the hedging disappearance. This is the piece of evidence that changed everything for me. Once you understand what this means, you can't unsee it. In commodity markets, when large buyers acquire material, they hedge. They lock in a price to protect themselves from volatility. This is Commodities 101. This is what every textbook says should happen. This is what has always happened until 2025. Commercial hedging activity in the silver market has declined materially. And once you understand what that signals, you'll never look at this market the same way. Here's why this matters. A buyer who hedges cares about price. They're managing risk. They're concerned about what silver costs tomorrow, next month, next quarter. A buyer who doesn't hedge cares about one thing: possession. They want the metal in their vault, under their control. They don't care if it drops 20% next week. They don't care what the futures curve looks like. They want the physical asset, period. The disappearance of hedging activity is the single most structurally bullish signal I have ever seen in any commodity market, because it tells you that whoever is accumulating silver right now is not a trader, not a speculator, not a hedge fund running a momentum play. This is strategic, long-term, nation-state level accumulation. The kind where price is irrelevant and access is everything. And here's the kicker: prices move before policy. Let me say that again because it's one of the most important concepts in this entire video. Prices move before policy. The market is not waiting for an executive order or a tariff announcement or a press conference. The market is watching the physical flows. It's watching the hedging data. It's watching the inventory reports. And it's pricing in a future where access to silver is more restricted, more contested, and more geopolitically sensitive than at any point in modern history. That's receipt number 3. Hedging disappeared. The buyers want metal, not price protection. Receipts number 4. The desperation premium and export lockdown. Now we arrive at the evidence that reveals desperation. As Chinese entities lost access to the upstream Latin American supply, their behavior changed. Reports surfaced throughout late 2025 of Chinese buyers approaching producers and refiners with offers for finished silver, not concentrate, not doré, but refined delivery-ready silver, at premiums of $3 to $8 per ounce above spot price. Let's do the math. At $82 spot silver, paying an $8 premium means they're willing to pay $90 for the physical metal. Does that sound like normal buying behavior to you? That's panic buying. That's a buyer who has lost access to their primary supply chain and is willing to pay whatever it takes to secure the metal they need. Think about it from their perspective. For 5 years, they controlled the upstream. They bought raw material at source and processed it themselves. That pipeline is now being disrupted. So what do you do when you lose access to concentrate? You go after the finished product. And you pay a premium that makes no economic sense unless you understand that your supply chain is being squeezed. That's receipt number 4. The premium tells the story. And then, on January 1st, 2026, China officially implemented export restrictions on silver. Now most people interpreted this as China weaponizing silver, and the headlines certainly framed it that way. But I want you to think about this differently. Export controls are not offensive moves. They are defensive moves. They are the moves you make when you're losing. If you controlled global supply, why would you restrict exports? You wouldn't. You'd sell at premium prices and profit. But if you were losing the supply war, if your pipeline from Latin America was being cut off, then you lock down what you have left. The licensing regime is strict. Only companies with annual production above 80 tons and credit lines exceeding $30 million qualify. Basically, state-approved entities only. China is protecting domestic reserves because they recognize that the game has changed. That's receipt number 5. Export restrictions reveal defensive positioning. Receipts number 5. The vault drain and lease rate spike. We're now going to look at 2 pieces of evidence that confirm everything we've covered so far. And these are not estimates. These are reported figures from the exchanges themselves. Receipt number 6, the vault drain. COMEX registered silver inventory, the metal that's actually deliverable against futures contracts, stood at 167 million ounces in October 2025. By February 2026, that number had collapsed to approximately 103 million ounces. That's a 38% decline in 4 months, 64 million ounces withdrawn. And here's what makes this extraordinary. January is traditionally a quiet month for silver deliveries. It's not a major contract expiration month. Deliveries typically run between 1 to 5 million ounces historically. January 2026, 49.4 million ounces delivered, an all-time record for what's supposed to be a sleepy month. People aren't rolling their contracts. They're standing for delivery. They want the actual metal, and the vaults are hemorrhaging supply as a result. That's physical evidence. That's not a theory. That's metal physically leaving the warehouse system. Receipt number 7. The lease rate spike. In London, the cost to borrow silver, what's called the lease rate, tells you how scarce physical metal is in the professional market. Normal lease rates sit below 1%. That's the baseline when supply is adequate. On October 9, 2025, London's 1-month silver lease rate spiked to 34.9%, with intraday peaks touching 39%. As of early February 2026, rates are running between 6% and 8%. To put that in perspective, if supply were plentiful, professionals wouldn't be paying premium rates to borrow metal. Yet they are, because real deliverable silver is scarce in the world's largest precious metals trading hub. That's receipts 6 and 7. vaults draining, lease rates elevated, both confirm physical shortage in the face of price volatility. Convergence. When all signals point the same direction. Let me pull this together, because if you're still with me at this point, you now understand something that puts you ahead of most market participants. We've established 7 independent pieces of evidence. Receipt 1. China executed multi-year upstream acquisition strategy through offtake agreements. Receipt 2. The flow reversed in 2025, metal now routing to U.S. refineries instead of Asia. Receipt 3. Commercial hedging disappeared, signaling strategic, not speculative buying. Receipt 4. Chinese buyers paying $8 premiums above spot for physical metal. Receipt 5. China implemented defensive export controls January 1st. Receipt 6. COMEX registered inventory down 38% in 4 months. January deliveries at all-time highs. Receipt 7. London lease rates 6 to 8% after spiking to 39%, indicating persistent scarcity. Now add the context. The world is in its 6th consecutive year of silver supply deficits. This is not one bullish signal. This is not speculation. This is 7 independent data points, all publicly verifiable, all pointing in the same direction, all occurring simultaneously. And I want to be clear about risk, because I never present only one side. I hold silver. I have exposure to mining stocks. I have skin in this game. And there are things I cannot see clearly yet. How exactly is the U.S. securing Latin American supply? Is it government coordinated or private sector driven? How will China respond? They could escalate with higher premiums, pivot to African or Australian sources, or weaponize their dominance in refining capacity. And the timeline is uncertain. This could resolve in 6 months or play out over 3 years. Resource conflicts don't move on a trading calendar. But here's what I know. The physical flows have changed. And silver at $82 is trading in a world where the 2 largest economies are competing for strategic control of the supply chain. Actionable steps. If this thesis is correct, it will confirm itself through trackable metrics. I'm going to give you 3 specific things to monitor, not vague suggestions. Actual data points you can check weekly. Metric 1. COMEX registered inventory. Currently at 103 million ounces. If the drain continues at the current pace of roughly 780,000 ounces per day, we could hit 85 million by the March contract expiration. Watch the CME daily stock reports, freely available on their website. What it signals: if registered inventory falls below 100 million while open interest remains elevated, delivery pressure intensifies exponentially. Metric 2. Shanghai Premium over COMEX, currently running $3 to $5 per ounce, with reports of $8 in some markets. Track Shanghai Gold Exchange silver prices versus COMEX front-month futures. What it signals: if the premium expands from $8 to $10 to $15, it means Chinese desperation is growing and arbitrage flows cannot close the gap. Metric 3. London lease rates currently 6 to 8% for 1-month silver, down from the October peak of 39%, but still roughly 6 to 8 times normal. Monitor Bruce Ikemezu's data from the Japan Bullion Market Association. He posts this publicly. What it signals: if lease rates spike above 10% again, it means London's physical shortage is re-intensifying despite the January price crash. These 3 metrics are forward-looking indicators. They don't tell you what happened last month. They tell you what's building right now. You don't need to trust my analysis. Watch the data yourself. If I'm wrong, these metrics will show it. If I'm right, they'll confirm it before the price fully reflects the reality. That's how you follow the receipts. We started with a contradiction: inventory draining while price crashed. Now you know why. The price crash was leverage getting flushed from the paper market. The inventory drain is the physical market responding to nation-state level competition for a strategic resource. Pause. 2 different markets, 2 different dynamics, and the transaction trail reveals which one will ultimately win. If you got value from this investigation, subscribe to Global Money Report. We follow the receipts on markets, money, and monetary policy every week. No hype, no narratives, just data, transactions, and forensic analysis. Drop a comment and tell me, which of the 7 receipts surprised you most? Or if you're tracking additional data points I didn't cover, share them. This community makes better analysts out of all of us. The vaults are still draining, the flows are still shifting, and silver at $82 is still trading in a market where possession has become more valuable than price. The receipts don't lie, and neither does the metal leaving the vaults. I'll see you in the next one.